Right, well, let's focus on a clutch of stocks that have opened up well in the green, and the last few trading sessions, they've done quite well. The OMCs and the oil-related plays, because we have overnight Brent crude prices which fell, sub that $70 per barrel mark on OPEC plus plans to hike output. To decode this, we have with us Dayanand Mittal, the oil and gas research analyst at JM Financial. Hi, Dayanand. Good morning, and thanks a lot for joining in. Well, crude oil prices are lower, so let's focus on the OMC piece first. They have been relative underperformers, but now you have valuations in favor, yields as well in favor, and dare I say that we don't have a state election for the next many months as well, which could bode well for them. What's your top pick from the OMC space, and what are you factoring in now in terms of Brent crude prices? I think earlier it was around $75 per barrel, which has been revised downwards. Tell us more.
Yeah, so first to start with crude price outlook, given that's what will decide the fate of OMCs and ONGC Oil India. So we have been a bit bullish on crude over last 2 years, expecting crude to be supported around 75-80, which kind of largely played out, given OPEC had a very strong pricing power. But that pricing power has gradually got eroded, given that we are heading from a deficit scenario in terms of global oil demand supply into a more surplus scenario in CY25. So it'll be about at a 0.5 million barrels per day surplus in CY25 versus deficit in last 2 calendar years. So adding to that erosion in pricing power for OPEC, the entry of US President Trump push to Saudi and OPEC to lower oil prices added to the pressure on oil prices, and we believe that's a key reason why OPEC Plus eventually decided to hike output after being delaying it for last year or so. So we believe, though this came as a negative surprise for us and for market, and hence oil is now closer to $70, we don't see a scenario where oil goes down to $60 or so, because I think the key thing which will decide whether oil is at 60 or 70 is what is US President Trump's desire. We believe he just doesn't want a lower oil price for his US consumers, but he also wants an oil price which is supportive of US oil and gas companies, particularly all those who are doing capex in US shale. And our sense is they need $65 to $70 to justify the project viability. So our sense is $70 is what US president would ideally like oil to be at, and not 60. And second reason is, given the favorable relationship between President Trump and Saudi obliging to his call for lower oil price, so he would not like to push Saudi beyond a certain point. So Saudi's fiscal break-even is around $85. Saudi has obliged to President's call for lower oil price, and hence their hiked output. We don't think US would like to pressure Saudi to take oil to 60, because that could significantly hurt the fiscal deficit. If that were to happen, we think Saudi will make a U-turn in their output hike decision, and they will either pause this output hike or maybe even go for a cut as well. So $70 is what we are working with. So given that backdrop in oil, OMCs, we have been negative since last 2 years. Valuations have now become more favorable. They're trading at about 1.1 time price to book, which is in line with historical average. So risk reward is now more balanced, and hence, though we have still maintain a cautious view, but we think the risk reward is balanced, and one can, if one has a bearish view on crude, maybe they can take a more constructive view on OMCs. We still think crude would be supportive of 70, so we prefer ONGC Oil India or OMCs even at this juncture.
Okay, so you prefer the OMCs, you're saying. For Dayanand,
ONGC Oil India or OMCs.
ONGC Oil India over the OMCs. For OMCs, with this kind of a reduction, I mean, what is the, there's of course on the marketing side, if they don't pass it on, then it becomes better marketing margin. On the refining side, I mean, in general, what's the sense on GRMs?
Yeah, so first on the marketing piece, we all know, given the history, that this is not a sustainable earnings that they'll be making. Current marketing margin on auto fuel has jumped to 8 to 9 rupee per litre versus historical 3.5. So we all know if crude stays here, government will either hike excise duty on auto fuel to boost its revenue, or maybe pass it on to consumers. So we are building a sustainable marketing margin of about 4.2 rupee per litre, still higher than 3.5. Excluding LPG losses. And if you were to adjust for LPG losses, then we are building in closer to 6.5 to 7 rupee per litre auto fuel marketing margin. In terms of GRM, there have been a bit negative surprises, particularly OMCs and all the Indian refiners have been enjoying about $1 to $1.5 benefit in terms of the GRM because of Russian crude discount. Given the US renewed sanctions on Russia by the Biden administration in Jan, that is likely to lead to sharp decline in OMCs or all the refiners' Russian crude import from about 35-40% to maybe sub 20%. More clarity will emerge over the next few months. And also the discount will narrow from $3 to $4 to maybe sub $1-2. So that will be one hit to their GRMs. And second is excluding diesel, where cracks are still reasonable at $15 in line with historical average. Other product cracks, gasoline and others have been a bit soft because of weak global macro setup. So yeah, overall GRM has surprised negatively over the last 2-3 quarters.
Dayanand, I think I had one more, but I think we'll have to save it for the next time we speak. We're just 3 minutes away from market open. Thank you very much for joining us.
Thanks a lot.
It's a pleasure speaking with you. Well, let's get